The dot-com financial crash, also known as the dot-com bubble, was a period of speculation and excessive growth in the technology industry, specifically in internet-based companies, during the late 1990s and early 2000s. During this time, investors poured money into internet startups with little or no revenue, and many of these companies went public with sky-high valuations. The bubble began to burst in March 2000, when the Nasdaq Composite, an index of technology stocks, peaked at 5,048. From there, the index began a steady decline, losing 78% of its value by October 2002. Many internet companies, whose valuations had been based on the expectation of future profits, were left with little or no value. Many investors, including individual investors and institutional investors, lost a significant amount of money. One of the main reasons for the dot-com bubble was the widespread belief that the internet would revolutionize the way business was done, and that technology companies were the key to unlocking this potential. This led to a feverish demand for internet stocks, and many companies were able to raise large amounts of money through initial public offerings, IPOs. This bubble was created in part due to the wide availability of easy credit. As interest rates were low, investors were able to borrow money at low rates and invest it in internet stocks. Many also leveraged their assets, leading to enhanced buying power. These combined for a surge in demand for internet stocks, pushing their prices higher. However, many of these companies had little or no revenue, and their valuations were based on the hope that they would be able to generate profits in the future. As the market began to cool and investors became more skeptical, it became clear that many of these companies would not be able to meet these expectations. This led to panic selling and many companies going under. The most well-known example was a company called Pets.com, an e-commerce company that sold pet supplies online. It raised $82.5 million in an IPO, but went bankrupt in less than 2 years due to high marketing expenses and lack of profitability. The crash had a significant impact on the overall economy in the US and abroad. Many technology companies were forced to lay off employees, and the unemployment rate in the technology industry rose sharply. The crash also led to a decline in consumer confidence and spending, which in turn led to a generalized recession. The dot-com crash also had a lasting impact on investments in the technology industry. Many investors became more cautious and demanded more evidence of a company's ability to generate profits before investing. This led to a shift in focus from growth to profitability in the technology industry. Overall, the dot-com financial crash was a period of excessive speculation and growth in the technology industry during the late 1990s and early 2000s, which led to a bubble that eventually burst, costing investors their money, and changing the way the technology industry thought about valuation of companies.